The 100-year pattern, presidential election cycle analysis. What you learn in this webinar: the 100-year pattern, when 49% cumulative return is turned to 5,000%. Why the market's worst 52 days can destroy your gains. How skipping a single window 5x's your returns. The real truth behind the sell in May myth, and the one presidential cycle year that changes everything. Yeah, so you have been looking at TradeWave, so I guess you have some familiarity with it. I've been so busy with the book, I haven't spent much time creating videos lately, but that's going to change. So, and I'm going to be available on Zoom, hopefully at least once a week. You understand the basics of it, so.
Yeah, sure, absolutely.
I actually have this. I usually cover this when I show this to people, that how these two sides are completely independent of each other. The right side is the wave viewer, and this is how we analyze a pattern, and the left side is what the data analytics engine finds as pattern. Do you understand the trend chart? It's a statistical chart, and only the trends matter. And right now we're looking at 10 years, so we can look at any number of years, and the trend chart creates statistical trends for the number of years we're looking at. But I will go to indices common, S&P 500 index. We have 97 years of data for S&P 500, and I'm going to select buy and hold, which is a date range shortcut for being market from 1st of January until the following 1st of January, which means you never get out. This is right now the performance for every single year since 1928. Now, when we look at this screen, look at the bottom, cumulative return, which I use for statistical valuation of a pattern. So right now, this means that if you got in to S&P 500 in the beginning of 1928 and you held it until now, you would have made 32,942% so far in 97 years. It's a very respectable number for the broader markets. But one thing that I have found over 97 years is that there is a weak period, which I call it, oh, I didn't save these. I call it the 52 days of hell. It is from th of September, and it lasts 52 days. Statistically, this is the weakest period for S&P 500 based on last 97 years. And how do we know that? Look down here. TradeWave puts a green square here, which means it considers it a bullish date range. But the cumulative return for this date range is minus 76%. You would have lost money over 97 years. There's another feature here called reverse date range, which means what would this look like if we were in the market the whole year except the current selected year, so selected date range. when I select this, now we can look down and compare what happened to the cumulative return. The cumulative return of the date range went from 32,942% for buy and hold to 163,137%, which is a 5x return over 97 years. I call this the 52 days of hell. Many crashes have happened and many bear markets started during this period of time. But looking at 97 years is cool, and finding this 52 days is nice, but there's a much better way of analyzing this, and that's with the US presidential election cycle. Why is US presidential election cycle so important? I mean, this is something that I've been asked before, and it all comes from how the world economy runs. United States has 4% of the population of the world. But if you look at the world's GDP, United States is responsible for 27% of the world's GDP. There is nothing that comes close to it in this magnitude. So whatever happens in the United States market affects the entire world. That's the reason of the size of the capital and the changes that happens. So what if we look at it with the presidential election cycle, which is 4 years, and we can look for key signatures. And by the way, this button I'm clicking, you can either look at January to December for anything, or if you uncheck this, whatever the date range is, it creates it. The first date is 2 weeks before the beginning of the date range. It's just something that helps for viewing. So now I'm going to sell like buy and hold, and we are on presidential election years, and we can see the trend chart for presidential election years, which is interesting, but right now is PE+1.
It is plus last year.
Right, this is the year after a presidential election. So we click this, we end up with this trend chart, which starts in 1929, and if you look at the bar charts, it is showing every 4 years the gain and loss from 1st of January to 1st of the following January. But look at what happens in the beginning. It is very volatile. It goes up, it goes down, it goes up, it comes down. What if we look at the first quarter? This is first quarter of PE+1, which is this year. It is very volatile. Very volatile. What would you expect to happen this year? There was a probability of very volatile times, like it happened in 2009, in 2001, in 1977, 73. This probability was there, and we didn't know it. So news headlines change, but the seasonal winds were in place. And this is exactly what happened. But look at what happens right here, a little bit further to the right. Right about there. Right after here, it starts going up. And it keeps going up sharply till here, which is the 2nd of August. This is the reason I created that video and said markets will have a high chance of rising until 2nd of August. It's 118. There it is. See? From the 7th of April until the 2nd of August. It's gone up every single year since 1985. Since 1929, it's gone up 84% of the years. Right there. It's showing it. Look at the cumulative return. The cumulative return of just this 118 days that we selected is 586%. But if you just bought and held S&P 500, every single PE plus 1 year, you would have only had 229%. You would blow away the gains of the year with being in the market 1/3 of the time.
Beautiful.
This is the reason I said the broader markets should go up. Of course, there's always a chance of a tornado, something big, and seasonal, it's going to overshadow seasonal winds, and that's going to be, that's what I call an outlier. But this year was no outlier. 2025 looks pretty similar to all these other years since 1985.
It does.
And stronger. I mean, 93 was up 1.68%. These are the weaker ones, but 18.15% up to now. That's why I consider that pretty bullish till the 2nd of August.
Pretty strong evidence.
Yeah, I mean, tornadoes can happen, but if they don't, chances are this is going to repeat. And it did this time. But look at what happens right after here. There's some down coming. Right there. Suddenly now we see a lot weaker time. Although in 2009 and 2017 it was long, still it was positive, but the negatives and the downs are much longer. And look at the red square up here. TradeWave considers this date range as a better short than a long, probability wise. So this date range showing right here, right there, this date range is possibly weak up to here. And oh, this didn't go away. There. And probably up to there. It's a little stronger. The last 4 P+1 years were positive when we go all the way to 26th of October, but still pretty weak the previous years. But look at what happens afterwards. So right there, when we select this period, look at that, 27th of October going to 4th, or maybe even a little bit longer, let's say 43 days. There. It's been positive since 1977, going for the date range of 27th of October to 8th of December. Last time this date range went down was 1973. So I consider it bullish starting October 27th, and it's actually pretty the same if you go to the end of the year. Since 1977, it has been bullish the entire years. So this shows us that seasonally, this is a bullish year after 27th of October. If something bad is going to happen, there's a higher chance it's going to happen in the negative side that we've shown. But this time is, so what do we do when we have such a strong bullish tendency? Then we can not only just trade this, but we can trade securities that are fairly positive and correlated to these, and we can find those also here by going to S&P 500 stocks for those days. So this is a typical way that I trade. I look at the broader markets. I found periods of time that has high probability for broader market to go up. And then when I find those times, I go here to S&P 500 or NASDAQ or Wilshire, and I pick stocks that have a bullish seasonal tendency, and I do it, and I start trading those.
Right, so you do it stepped, you do it phase-wise, you don't directly look at stocks, individual stocks, you first look at the broader market.
Always. And remember this is showing you history lessons. None of these things mean that nothing is guaranteed it's going to repeat. It's just a higher probability. If you want to increase your chances, analyze the broader market too. Like if you want to compare it to technical analysis, when I used to use technical analysis exclusively, I would look at a higher time frame, find a bullish tendency on, hourly or daily, and then try to trade the same thing hourly. It's similar concept, but I think this is more statistical based. This is the reason I don't use technical analysis anymore. When I would lose, I didn't know what was my chance of this loss. Is this going to happen again? That drove me crazy, and it wasn't based on statistics. And
all in the probability game, and it's much more good for your for the calmness, for the mind, if you can base your opinions and your bias on statistics than on patterns. And of course you can backtest those patterns, but still it's a very hard, delicate thing to do, with a lot of manual and emotional thinking attached to it. So,
but backtesting here is much easier.
Absolutely, and statistically proven. So it's really probability proof.
Right. So Jason uses TradeWave not exclusively as a way to create his strategies, but he filters them with it. He kind of uses it like the way I showed you the broader market. Like he actually knew about this 7th of October, 7th of April last year. We had talked about it. So he had it on his radar for a long time because we talk every couple of weeks. But this is just the basic way of the one I look at it. But let me show you the pattern I am the most excited about. I have found a pattern that I actually ended up naming the book about. The 100-year pattern.
I missed the last thing you said because the audio.
Oh, sorry. Oh, I was saying that I really want to show you what did I name the book 100-year pattern for, and I found this pattern just recently while I was doing research for the book. I mean, I developed this platform. This was pure mathematics and software data and analytics. That didn't mean I knew how to use the data for trading. It took me time before I actually started understanding the data I was generating myself. And since there's no information, it required research. yeah, the environment's unique. So, but let's take a look.
And the story you tell in the book is also really fascinating. It could be a chapter in Market Wizards. And hey, who knows? You'll be invited for the next interview.
Yeah, I hope so. A lot of information we take out of TradeWave could literally be financial news. Things people just don't know. This is what happens this time of the year. People know of a few things like sell in May and go away with no numbers to back it, or Santa Claus rally.
Yeah, true.
And
true.
Nothing to back it. With this you can back it. And by the way, sell in May and go away is 75% wrong. It's in the book.
and turn around Tuesday.
Yeah, most of those are just cliches. But it is fascinating. I'm going to have a blog or a video about, and I have one about sell in May and go away, but I'm going to have more based on better numbers. But don't sell your stock in May. Actually, the summer months are statistically the same or slightly stronger for 3 out of 4 years of a presidential election cycle. The worst one is the midterm election years or PE+2. Here
the word seasonality also doesn't come up quite a lot on FinTwit or on in others. One of the few traders, the better traders I know, Jason Burrs, he was the first one using the word seasonality, and I had to look it up what it meant.
Wow, really?
Yeah.
Well, what's so fascinating is because finding these patterns and doing analysis was really hard. There are some software that do a subset of what TradeWave does, but they are not complete. They don't do everything. Of course, TradeWave could have more features, but TradeWave does 90% of the fundamental information that's needed for pattern detection. Actually, more like 99%. But let me just show you this PE plus 2 years. Look at this. This is since 1930, going all the way to 2022, which is the last PE plus 2 midterm election year. It is crazy volatile, but it's down. Look at the sharp down here. Going all the way to right here, around 618 or so.
Yeah.
Right there.
It's very obvious if you look at it like this.
Yeah, I mean, this is the only year that sell in May and go away works. Yeah, that's the best year to not be in the market if you don't have seasonality and you don't have TradeWave and you don't want to trade. If you're out of the market, you're statistically better off. Until here. Until this bottom right there. So this is what I've found, and this is why it's so fascinating.
It is. Yeah, one can wander on the TradeWave site for hours.
Yeah.
But still, you have to lead your life as well. So
Yeah. Yeah.
But it's you can really dive into it. It's lovely.
Yeah, one of my users one time told me that when I'm sitting and waiting at the doctor's office, I don't play video games anymore. I just flip on TradeWave. By the way, have you tried TradeWave on your smartphone?
Yes, I did. And luckily I've got a big one with a big screen.
Uh-huh.
And then it works perfectly on the smartphone.
Yeah, it works pretty well. But let me show you this. 295 days. Look at this. This is PE plus 2 years, starting on a PE plus 2 year, which is 2026, next year. Starting on September 27th, you start going for 295 days until July 18th of the following year. This period of 295 days is fascinating because look down here. The cumulative return, by the way, it's been positive every single year since 1930. It's never lost after 1930, ever. 96.
One of the strongest waves there are.
It is. This is why it's the name of the book. And it's in chapter 7 that explains it. The average gain has been 20.63% over almost 100 years. That includes this big drop in 1930. And what is so fascinating is now it's this cumulative return. If you were to do a buy and hold on the PE plus 2 years, you would have made 49% since 1930. If you would have done this period that I'm showing, you would have made 5,045%. Now, I haven't crunched these numbers yet, but 295 days of 4 years is a little over 20%. 20% of the days are responsible for over 50% of the gains of S&P 500 since 1930. This number cumulatively is actually really high, comparing it to 32,000% that I mentioned. It is responsible for a very large percent of the gains of S&P 500 and the broader markets. This is the information I'm showing you over here does not exist. No one has ever talked about it. And I don't even think anybody's ever figured it out. And if they have figured this out, they are keeping it to themselves. This is the greatest period.
It is. It is. It's amazing.
Last time, it was up almost 25%. Worst case scenario, it was up or flat in 1978. That was 1978 when the Iranian oil crisis was. So markets were on an outlier. And it still broke even. So this is something I discovered only when I was doing the book research, and this is really, when I say 100-year pattern, I really refer to this.
It's awesome to see, and
right.
Very, very impressive, deeply impressive.
Yeah. I mean, everything else I talk about, there is some information about it out there. Not this. This is unique information that we are talking about here. And this is, I myself am the most proud of this discovery. TradeWave did a good job at finding it. "96% of the years was profitable, and 100% since 1934. So this was the basis of what I wanted to go over. There's so many things I can go over it, but I'd love to show you anything that you may have a question about.
Well, it's a question I thought of earlier when we just started.
Yeah.
It's about the steps you take. First you look at the broader market direction and find the direction in that, and then you go to the second phase where you look at stocks that correlate with that move, with that wind that's blowing from the direction. Do you have some specific steps in doing that as well?
Yes, actually, that's really good. I do have that. Let's go back to PE+1, and the discovery that we found was right here.
Mm-hmm.
And it all really depends on the type of trader you are. So let's say we decide that this market is going to be bullish, and especially there's another bullish period right here. Since 1985, it's been up from 23rd of June, which is 3 days from now, starting this coming Monday, until August 2nd.
I keep getting blown away about the amount of data that's being used here. It's so incredibly much.
So let's look at S&P 500 stocks. Now S&P 500 stocks, when I select it, it automatically goes to 10 years with 9 out of 10 years, which means it has to be at least 90%. You can go to 10 of 10 and you can see it finds 92 opportunities. 9 out of 10, it finds 292 opportunities. 8 out of 10, it finds 428 opportunities, which means...
That's a lot.
Right. So how do we find what we want up here? On the top, it automatically, by default, it ranks it by Sharpe Ratio, which you can see the top one is Steris. Right now, 10 out of 10 years, it's done pretty well from the 20th until 12th of August. However, when we look at trend chart, it might be better here. Actually, no, Sharpe Ratio dropped, so that was a better choice. Sharpe Ratio of 3.78 is better. But what I was going to show you, but the type of trader you are, for example, I myself typically do short-term trading, and then I have it in the book also. When I do short-term trading, I take 80% of that and I put it on long-term. But how do we deal with short terms? I'm only interested in 20 to 50 days. If you go to filter, you see how we have 428?
Mm-hmm.
I say 20-50.
Oh, that's a nice one.
And you end up with only 20 to 50 day opportunities, and it just drops to 187 opportunities down there. I also am interested only in Sharpe ratios that are above 1. See, some of them are below 1.
Mm-hmm.
So I do a semicolon, SR greater than 1. Now we dropped 67 opportunities here. I am also interested in average profit over here to be over 5%. So I say AVG P greater than 5. Now we only have 32 opportunities down here. See that?
Yes, absolutely. And I'm glad you're. This is a recording, so I can look it back because this is very, very good to be able to filter like this.
Now,
The
if you don't,
filter.
if you forget anything, if you're on a desktop, you can click on tooltips and just go over it, and it will give you some of this information right there.
Oh, yeah, I see it. Yeah.
And this is without delay. I do not like tooltips with delay, so I put a on-off button instead up there. Now, do you know what TWWA and TWWR are?
Was it the amount it is fluctuating to the downside and upside?
No, it's actually a measure that's unique to TradeWave that I have developed. If you're familiar with Sharpe Ratio, which I actually have a video about it. Sharpe Ratio really shows you the consistency from day to day, year to year for these. So this is high Sharpe Ratio because all of these are very close in size. When you click on MFE, it shows you the extent of the move, like the light green part. By the way, you can also click on any of these and look at the historical trade for that year. So I just clicked on 2023. Do you see how it went up, made a peak over there, then came down and closed here? That beginning to the end is dark green. That peak to the end, the maximum high is the light green. So that's how much it went up. It was up an additional 11%, but then it closed up 7.28%. This is the extent of the move here, right there. Make sense?
Yeah, absolutely.
So
absolutely. That's what I meant earlier, what I said. And you also have got it on the reverse side. On the
right. I call that the drawdown, or MAE, maximum adverse excursion. That's how much drawdown you had previously.
Yep.
So Sharpe Ratio is calculated based on this dark green part. TWWR is calculated based on, it's a Sharpe Ratio calculated based on dark green and light green added together. Why is that important? It's important especially for short-term traders, because my favorite strategy is at-the-money credit spreads. At-the-money credit spreads, I am looking for a jump up in the move of the security, and I'm out. So I care about this light green part. Many times I've cut the light green part, I'm out with a pretty decent profit, and then it comes back down and I'm already out. So for short-term traders, this is really good. And TWWA is just basically the average profit of dark and light green added together.
Right.
So many times
green is the average price, which is also given, like the 8.34%. That is the green.
Exactly. The dark green part is the average P. Like here is 8.34%, but TW average is higher because it adds the light green part to it.
Exactly.
I
so
use this
end up
information
in the light green with the trade.
I use this information when I'm doing short-term trading. And you can also say that here, maybe I want TW ratio to be greater than 2. Then I end up with just 5. See that?
Yeah, yeah. There you go. And this is how you select. This is a way to
This is how I filter huge lists down to my own desirable securities that I care about.
beautiful and very well explained this at the same time. Thank you very much.
Oh, you're very welcome. You know you can save these here too, right? In the
Yes. Yeah. You can make your own list of
portfolios, right?
of assets.
Here I can add them and then they'll be there. You can always recall it. Another thing you can do, it also creates a report that if you find anything, add it, and then suddenly you have a report, and you can use this report and share it. This is a static URL you can send to someone or post with all the information about the pattern. But this is the basics. Unfortunately, it cannot be taught in 5 minutes. It takes minimum of an hour or 2.
Of course, and it needs, you need to dive in, take the time to get to know it, make yourself comfortable with it, and eventually follow the right steps to approach the market and place trades.
Right. Now, when you look at the book, you see that I also listed several trading strategies which are my desirable trading strategies. These are strategies that I have used in the past. Not necessarily all of them with TradeWave yet, but those are the strategies I've done. I didn't list all of them. Another big strategy that I always really liked was ratio back spreads, which are perfect things to do during like a potential time for a crash, market crash. If you can catch it, you can make incredible amount of money. Although it's also in the book that I one time made $400,000 with a $4,000 bet in 2008. I somehow, by some luck, I was able to be right at the right time in 2008 during the crash. And I thought I'm gonna have $1 million, but good thing I got I could have had more than 400,000, but I got out at around $400,000.
What a story! What a story!
Yeah, it was painful. It flipped me out afterwards, and I could not make any money trading for a while. I just couldn't. Nothing worked. And I also on the blurb of the book about Paul Tudor Smith, the guy that made $100 million during 1987 crash. The reason I heard about the story on him is because he couldn't trade after that big win. He was so bad that he went to Tony Robbins, the famous Tony Robbins, and Tony Robbins mentioned the story, and that's how I knew about the story, and I looked it up.
Right. Yeah. It's so, must be so painful if you're so high up and then it crumbles.
And then it crumbles, and I couldn't get myself to trade the right way. Everything was terrible way of trading, the way I was doing it afterwards. It took years before, about 2-3 years, before I started becoming back to normal.
Well, it's part of the hero's journey, and it's a story which one can find in a lot of the greater traders that they have had that dark moment and then had to get that harsh lesson.
Right. Yeah, I mean, I don't consider myself a good trader, but now I have a way to trade that I know I am consistent. Because
if
I
you
actually
don't call yourself a good trader, then I don't know who to call it. Afshin, I think that's too humble.
no, it's I mean, trading is hard. Somebody had the greatest explanation. When you're in a trade and you don't have a plan, it's the same when the market goes up and down, or down. It's the feeling that somebody just dropped a box full of snakes on your lap. It's the fear, not being able to sleep, not knowing, hoping it's going to go up tomorrow, not knowing, is it not? Well, those days are over for me. I am now have a way for myself to assess what are my chances of winning. So
true, and I think you've given the traders who use TradeWave also something that is very good for the psychology, because you give a statistical backbone to them,
right,
and this gives it's of course it's not a hard assurance, but it's it's proven probabilistically. So my take is that it's much better for traders to use this statistical information for their psychology than to read 3 psychology books on trading.
right, or read the news on CNBC. My God,
Yeah.
that just tell you a funny story. In 2023, I looked at PE plus 3 years because it was a year before a presidential election, and I saw it being extremely bullish. Extremely bullish. I mean, I didn't even show you that one, PE plus 3 years. Oh, I was going to do this. Indices comment. Look at how incredibly bullish for the year of 2023 is. So I made a video. And I said that this is, and the news was so doom and gloom then that I doubted myself. And even in the video that I made, I wrote, if market's going to turn around and have an outlier, it means the market has turned over, because typically this year is bullish. Of course, 2023 ended up becoming bullish, but I have a video saying that. It's in my old channel, which is called Trade Seasonals YouTube channel, but it's there, and I doubted in myself. I actually didn't go in the market. I felt really stupid at the end of the year that I predicted it right, and I was influenced by the news. The news was incredible then because of the war in Ukraine. We were just waiting for the world disaster to happen.
True, but you were obviously not the only one. The whole world was doomed. Thinking, and what's the distraction then? The news or the statistics?
Right. I'm a lot more comfortable now. I mean, I've now dove into this information so much that everything's changed for me too. Now I see this, I understand it, and I act on it. It's much more comfortable. But I hope this was helpful.
Absolutely, thank you very much, Afshin. I enjoyed it immensely, and I saw a few functionalities that I can dive into this weekend.
Awesome. By the way, I don't know if you trade any foreign stocks, but there's a London and Toronto exchange listed here.
Yeah, I now have IBKR as a broker, so I'm able to also trade some stocks on other exchanges. Not the Korea one, unfortunately enough, but London is okay.
Yeah. Do you do futures?
Yeah, I would like to, but I haven't got a chance to do it on IBKR. I don't have a. I need to get some permission. I've got all the permissions, but not for futures and commodities yet.
Oh, okay. Well, I don't know if Jason has showed it to you guys, but in a future, maybe the next one, I'll show you a few just fascinating. It's in the book. There is one about lean hogs, which is just mind-boggling pattern that I found. That
Oh, great!
it's been correct 44 out of last 45 years in a 2-week period. Bullish and
2-week period, you said?
2-week period. I can quickly show it to you before we finish. Lean
That's
hogs.
amazing. It's really
45 years. This is the 45-year trend chart. Do you see something amazing here?
Yeah, absolutely. You see this big, how do you call it? A BART. They call this a BART pattern, but an enormous quick rise. There you go. From
Look
the
at
9th of April until the 24th of April, which is
15
smaller than a
days.
month.
It's really 2 weeks, and it's
not
been
normal.
it's incredible. And then there's a reverse of it here in August, coming up.
Not normal, and obviously there's a story about it. There must be.
I really want to know what the story is. I just know the pattern.
We look at the pattern, we look at the statistics, and the stories are there, but they vary.
Right. But this is a fascinating pattern, and I do have it in the book also, because every year it still blows me away that it's there.
Wow. I can only say wow, and I can only recommend everybody to buy the book. I've read it, and it's mind-blowing. It's mind-blowing, and I guess this will take the trading world by storm.
Well, I hope so. I think for a while, when the information is not everybody knows about it, it's going to become a great tool. But 5-10 years from now, that may change, like it happened to turtle trading. Turtle trading now is used by so many people, it's markets efficient around it. Not here.
Yeah, the problem is there is so much distraction in the communications in the trading world. There are so many bright disco lights the retail traders look at, that sometimes the hard quality like this gets overlooked if you don't look well. So it's really for the connoisseur at the moment, but as you say, within a few years this will drastically change.
Right.
This
Exactly.
is a gem, this is a treasure.
Yeah, I have considered not putting this out, but then I changed my mind. I had some people actually wanting me to close TradeWave and just have automated trading system around this, but I didn't want to. I like this better.
And we, the public, like it this way, I've seen. Keep it up.
It's a
This is
little more
great.
fun talking to people like yourself.
Absolutely. It's a joy to talk to you and
Well-
to have this information available. It's awesome.
Well, Blake, I really appreciate you joining. I am really happy to have met you face to face.
Thank you very much, Afshin. And if there's anything I can do for you from the Netherlands outwards, please let me know.
I appreciate that. And you know my email, right? afshin@tradewave.ai. You can contact me anytime.
Super.
All right. Thank you very much.
and
Have a good
looking
evening.
forward to next week.
Awesome. Oh, you're going to join next week?
Absolutely.
Great. Oh, I'm actually happier about next week now that you're joining. Good.
See you then, and all the best.
Same here. Bye-bye.
Bye bye.